Welcome, everyone, to the webinar. My name is Brett Liefbroer, and I'm an associate attorney here in Miller Johnson's Employee Benefits Practice Group. And I'm happy to welcome you all to the October edition of our Benefits Lunch Break webinar series. We have two more upcoming lunch break webinars for 2022. Next month's will be on November 16th, and we're currently planning on covering a retirement-related topic, but the topic is to be announced. And on December 21st, we'll be having our webinar in a Ask a Benefits Attorney format, with the full employee benefits practice group available to answer any questions that you may have. As always, if you have any upcoming topic ideas or a legal development that you'd like more information about, please let us know using the Q&A feature or in the post-webinar survey. Without further ado, today we're going to be talking about compliant medical and dependent care flexible spending accounts. Beginning with some background, a flexible spending arrangement is a self-funded benefit program that reimburses employees for specific expenses that are outlined in the plan document and are allowable under the Internal Revenue Code. The specific section of the code that governs medical FSAs is Section 105, and the section of the code that governs dependent care FSAs is Section 129. FSAs may be funded with employee and, in certain situations, employer contributions. Typically, FSAs are funded on a pre-tax basis, with employees making salary reduction contributions to their FSA. In some situations, employers will provide an employer contribution, usually with respect to medical FSAs, but sometimes with dependent care FSAs as well. To the extent that employees make pre-tax salary deferrals to their FSAs, those need to be made through a Section 125 cafeteria plan, which is why medical FSAs and dependent care FSAs are typically included as component parts of those Section 125 cafeteria plan documents. And we will be starting with medical FSAs today. Medical FSAs are subject to many different federal laws. To the extent that these federal laws apply will vary based on the specific medical FSA plan design. First, medical FSAs are subject to the Affordable Care Act. Not surprisingly, medical FSAs are subject to the Internal Revenue Code. For employers that are not governmental or church employers, medical FSAs are subject to ERISA. To some extent, medical FSAs are subject to COBRA continuation rules. Medical FSAs are generally subject to HIPAA's privacy, security, and breach notification rules, which are referred to as the administrative simplification rules. Generally, these are the rules requiring that certain protections must be applied to participants' protected health information. Finally, unless the medical FSA is designed as an accepted benefit, the FSA would also be subject to HIPAA's portability rules. Prior to the ACA, a medical FSA was not required to be an accepted benefit. As of 2014, medical FSAs are still not required to be structured as an accepted benefit, but they may run into problems with ACA requirements if they are not structured this way. From a practical standpoint, beginning in 2014, it was important that medical FSAs either be structured as accepted benefits, or, as we will discuss in a minute, be integrated with another group health plan. This is because medical FSAs will, by design, violate certain ACA market reforms, including the requirement that group health plans must provide first dollar coverage of preventive care services. As mentioned, this is the case unless the medical FSA is an accepted benefit or if it is integrated with another group health plan. Of these two plan design options, accepted benefits are the more common. So what are the requirements for a medical FSA to be integrated with another group health plan? Essentially, there's 4 different requirements for the medical FSA to be integrated with another group health plan. First, the employer that sponsors the medical FSA must also offer what I'll refer to as a traditional group health plan that is separate from the medical FSA and that doesn't consist only of accepted benefits. For example, an employer can't offer a medical FSA and a dental only or a vision only group health plan. The employer needs to offer a traditional group health plan. Second, employees participating, that is those employees who are actually enrolled in the medical FSA and making salary deductions or having employer contributions made on their behalf, must actually be enrolled in another group health plan that does not consist solely of accepted benefits. And that could be the group health plan sponsored by the employee's employer, or a group health plan sponsored by a different employer, such as a spouse's employer's group health plan. The medical FSA must be available only to employees that are enrolled in another group health plan. Similar to the previous requirement, to be eligible to make contributions or have contributions made on my behalf, I must be enrolled. Finally, employees and former employees must be given the option annually to permanently opt out of and waive future reimbursements under the medical FSA. And then on termination of employment, the medical FSA must either be forfeit or the employee must be allowed to permanently opt out and waive future reimbursements. This last requirement is easier to meet because it should happen naturally. Most employers under Section 125 plan rules have an annual open enrollment period in which employees can elect for the next plan year whether they want to continue to be enrolled in the medical FSA. And then when the employee terminates employment, he or she is no longer eligible to continue to participate in the medical FSA unless that employee elects COBRA. We'll talk about COBRA in a few minutes. And we do have one question in the chat, and it says, what is meant by accepted benefit? So accepted benefit basically just means that the benefit is structured in a way that it is not subject to certain ACA market reforms. So it's basically a term of art under the Affordable Care Act for a benefit that meets requirements that allows it to be exempt or not subject to certain ACA market reforms. And we also have a question about what age-dependent children are eligible for the FSA. Just stick with me. We do have that covered on some of the future slides, and we'll revisit that. But the second half of that question I can answer now. It says, if age 26, does eligibility end on the actual 26th birthday, end of the birth month at age 26, or end of the year? So that is a question that will be answered under the terms of the specific plan. So a plan could provide that the benefits will terminate at age 26, or it could be drafted to extend benefits until the end of the month that the individual turns age 26, which I would say is the most common, or the end of the year that the dependent turned age 26. I do see that as well. So to be an accepted benefit, 2 requirements must be satisfied. The first requirement is an availability condition, which means that anyone who is eligible for the medical FSA must also be eligible for a traditional group health plan sponsored by the same employer, not necessarily enrolled, but eligible. The second requirement is a maximum benefit condition. Under this maximum benefit condition, the maximum benefit available under the medical FSA cannot exceed 2 times the participant's salary reduction election, or if greater, the amount of the participant's salary reduction plus $500. For employers that only allow employees to make salary reduction contributions, this maximum benefit condition will be automatically satisfied. If an employer makes a dollar for dollar matching contribution, again, this employer will automatically satisfy this condition because this amount will not exceed 2 times the employee's salary reduction contributions. But if an employer makes non-elective contributions, which are contributions that are made regardless of whether the employee makes any contributions, the employer will need to be mindful of this maximum benefit condition to make sure that it's satisfied. There are limits that apply to medical FSAs. The limit under the Affordable Care Act for 2022 is $2,850, and this amount is annually adjusted for inflation. In fact, I have some breaking news for you all. The IRS just announced yesterday that the limit will be $3,050 for 2023. So if you think about it, for 2022, the maximum benefit that an employee can ever have, not including carryovers, is basically 2 times this employee limit, which 2 times $2,850 is $5,700. The limit applies on a plan year basis. The plan year is usually the calendar year, but that's not always the case. And the limit needs to be prorated for short plan years. For example, if you have a new medical FSA or you're changing the plan year for some reason, but that doesn't apply to new employees hired this year. For example, if I'm hired today on October 19th, I can still contribute $2,850 to my FSA, even though I wasn't employed all year. And the limit applies on a per employee basis. For example, if both spouses work for the same employer, each spouse can contribute $2,850. The limit doesn't apply to medical FSAs maintained by different employers. So if an employee works for 2 employers, he or she may contribute $2,850 to each FSA. Under both ERISA and the Internal Revenue Code, medical FSAs must be maintained using a written plan document. And this is typically satisfied through an employer's Section 125 cafeteria plan document. So what are the requirements for reimbursement under a medical FSA? First, expenses must be incurred for medical care under Section 213D of the code. Also, expenses must meet reimbursement requirements listed in the plan document. A plan document by design can further limit expenses. Many FSAs are designed to be as flexible as possible to allow all Section 213D expenses, unless the FSA is being designed to be a limited purpose FSA, such as a dental only or vision only FSA, which is typically the case to preserve an individual's HSA eligibility. Under the CARES Act, which was signed into law in 2020, medical FSAs may now reimburse over-the-counter drugs without a prescription. Before 2020, reimbursement of these amounts required a prescription. The CARES Act also specifically identified menstrual care products as qualified medical expenses that can be reimbursed under a medical FSA. The expenses must be incurred by the employee or participant, the employee's spouse, the employee's children who have not attained age 27 as of the end of the year, so essentially 26-year-olds or younger, or the employee's other tax dependents. For any expense that is reimbursed from a medical FSA, the employee is not eligible for a deduction for that same expense on their personal income tax return. That's to prevent an individual from double dipping. They don't get to have a pre-tax reimbursement and then also take a tax deduction for that same expense. Expenses must be incurred after the employee becomes a participant. For example, if I have a 30-day waiting period on my medical FSA, I can't be reimbursed for expenses incurred in that waiting period. With limited exceptions, you have to incur that medical expense during the plan year to be eligible for reimbursement. Finally, claims for reimbursement must be adequately substantiated. This is a third-party documentation requirement, which may be satisfied by an itemized receipt, an explanation of benefits, or some other document from an independent third party that substantiates that the individual did actually incur that expense. Also, the individual must provide a statement, which is often made on the reimbursement request form, that the individual didn't seek reimbursement for that expense from any other health plan coverage. Here are a few examples of items that are not reimbursable under the medical FSA. First is insurance premiums. Let's say I'm enrolled in individual health insurance that I purchased through the ACA marketplace rather than my employer's group health plan. I cannot be reimbursed under a medical FSA for that individual policy premium. I also cannot be reimbursed for long-term care expenses. Long-term care expenses typically include expenses associated with the elderly or homebound individuals who need help performing the basic personal tasks of daily life. And finally, as we just discussed, I cannot be reimbursed for expenses that are not properly substantiated. To the extent a medical FSA reimburses those expenses, the employer that sponsors the FSA may have an obligation to seek repayment from the employee who received the reimbursement. Medical FSAs are subject to the uniform coverage rule, which states that the maximum reimbursement amount that I elect has to be available to me at all times during the plan year, even if I haven't contributed that amount into my medical FSA. For example, I enroll in my medical FSA and I sign up to make $2,500 in salary reduction contributions. That $2,500 generally will come out of my pay pro rata throughout the year. So if there's 26 pay periods during a year, it's going to come out $2,500 divided by 26. So let's say I incur an expense for $2,000 on day one of the plan year. The medical FSA still has to provide reimbursement for that $2,000, even if there's not sufficient funds in my FSA, because I've only contributed a small amount so far that plan year. And we have a question in the chat. Can an employer waive substantiation requirements? So the short answer to that is no. The substantiation requirements are necessary in order for tax-free treatment of the reimbursement. Another question is, if a dependent turns 27 during the plan year, are they ineligible for the entire plan year? So the expenses must be incurred by children who have not attained age 27 as of the end of the taxable year. And whether that applies to the entire plan year is a good question. I actually would need to double check on that, and I don't want to give you an answer here that is incorrect. So please feel free to reach out to me after the webinar, and I can get you an answer to that question. So here is a common issue that comes up. The uniform coverage rule prohibits employers from recovering what are called experience losses upon an employee's termination of employment. Returning to the previous example, let's say I sign up to make $2,500 in salary reduction contributions. On day two, I incur a $2,000 claim, which is reimbursed. On day three, I terminate employment. And on day three, I've maybe put in about $25 through salary reduction contributions. The employer can't come back and require the employee to repay the balance, nor can the employer withhold from the employer's final paycheck that negative balance in the employee's medical FSA. That would be a violation of the uniform coverage rule under the code. Medical FSAs are also subject to non-discrimination requirements under Section 105H of the Internal Revenue Code. Basically, if you're going to offer tax-favored benefits, you must offer them on the same basis to your rank and file staff employees, in addition to your C-suite executives. Again, a health FSA cannot discriminate in favor of highly compensated employees as to eligibility to participate. And for this purpose, an individual is a highly compensated individual if the employee was in the top 25% of employees as ranked by pay. Medical FSAs are also subject to the use it or lose it rule, which basically prohibits employees from deferring compensation for long periods of time. Unused amounts remaining at the end of the plan year have to be forfeited unless the medical FSA offers a 2.5-month grace period or a carryover. A 2.5-month grace period allows employees an additional 2.5 months after the end of the plan year to incur additional expenses that are reimbursable under the medical FSA. But after the end of that 2.5 months, if there's anything left, the unused balance is forfeited. The ACA offered the ability to carry over an unused amount of $500 to the next plan year. However, in 2020, the IRS released guidance which allows employers optionally to allow employees to carry over an indexed maximum carryover amount to the next plan year. For example, the maximum carryover amount from the 2022 plan year into the 2023 plan year is $570. And just announced by the IRS yesterday, the maximum carryover amount from the 2023 plan year into the 2024 plan year will be $610. As previously discussed, the requirement to maintain a plan using a written plan document under the Internal Revenue Code is also a requirement under ERISA. ERISA applies to all employers except governmental and church employers. A summary plan description is also required. If the medical FSA has 100 or more participants, a Form 5500 is required. Finally, under ERISA, the medical FSA is subject to claims and appeals procedures. Medical FSAs are subject to a limited COBRA continuation obligation as long as the medical FSA is structured as an accepted benefit. First, COBRA is only available to qualified beneficiaries who have not overspent their medical FSA. For example, if I terminate employment today and I've submitted claims for reimbursement in the amount of $3,000, but I only had salary reductions in the amount of $1,500, COBRA does not need to be offered to me because I have overspent my account. For qualified beneficiaries with underspent accounts, COBRA only needs to be offered through the end of the plan year, rather than 18 or 36 months. However, a grace period or carryover will also apply. Medical FSAs that are accepted benefits are exempt from HIPAA's portability requirements, which has bans on pre-existing condition exclusions under the ACA. But medical FSAs are subject to HIPAA's administrative simplification rules, which are the privacy, security, and breach notification rules related to participants' protected health information. These administrative simplification rules generally apply. However, there is an exception, a small exception, for those employers that have medical FSAs with less than 50 participants and the employer self-administers the medical FSA, which is somewhat rare, which would mean that the employer is not using a third-party administrator to administer the medical FSA. These administrative simplification rules would not apply. Moving on from medical FSAs, the good news is that dependent care FSAs are not subject to as many federal laws because they are not group health plans as medical FSAs. Dependent care FSAs are subject to the Internal Revenue Code, as well as state unclaimed property and escheat laws. So for example, if you issue a reimbursement check to a participant under a dependent care FSA, and the check has not been cashed for a period of time, the employer may be required to remit the money over to a state under that state's unclaimed property laws or escheat laws. In these situations, I recommend that you may want to consult with an attorney to determine what are the laws in your specific state. Dependent care FSAs are generally not subject to ERISA, which I'll talk about more in a minute, not subject to COBRA because they are not a group health plan. And for that same reason, they are not subject to HIPAA or the ACA. Dependent care FSAs are only subject to ERISA in rare circumstances. For example, a dependent care FSA may be subject to ERISA if the employer requires participants to use a specific dependent care provider and only reimburses expenses for that provider. The reason this may subject a dependent care FSA to ERISA is because it may be considered an employer-sponsored daycare center. Dependent care FSAs must be maintained using a written plan document. While there is no ERISA requirement for a written plan document for dependent care FSAs, there is an Internal Revenue Code requirement for a written plan document. Generally, the income exclusion or a participant's maximum benefit is $5,000 if the participant is married filing jointly. And the maximum benefit is only $2,500 if the participant is married filing separate. Next, the limit is further reduced by the employee's earned income. Practically speaking, if the employee is earning less than $5,000, the employee is probably not putting much money into that FSA, but that would reduce the limit. Similar to medical FSAs, dependent care FSAs have reimbursement requirements. Expenses must be for qualified expenses, which are expenses incurred for the care of qualifying dependents, with the primary purpose of ensuring the individual's well-being and protection. Qualifying dependents are children who have not attained the age of 13, or a spouse or other dependent who is physically or mentally incapable of caring for himself or herself. And most of the time, these expenses are incurred for employees who have kids enrolled in a daycare or with nannies, which are relatively straightforward for reimbursement purposes under the dependent care FSA. The employee and spouse, if any, must be gainfully employed. The employee must be working, which is almost a de facto requirement because the employee must be working to be eligible for the dependent care FSA. The spouse must be working, looking for work, or a full-time student. The expenses must be incurred during the plan year in which the employee was a participant, unless the dependent care FSA includes a spend down feature. A spend down feature is a feature which is permissible, not required, that says if I terminate employment or participation mid-plan year, I can continue to spend down or submit expenses for reimbursement up to the amount that's in my dependent care FSA for the remainder of the plan year. At the end of the plan year, the spend down feature ends and unused amounts will be forfeited unless there's a grace period. And we have one question that says, does pre-K for 3-year-olds qualify for dependent care reimbursement? The answer is yes. This would be an expense eligible to be reimbursed for from a dependent care FSA. We also received a question that, what if the spouse is working part-time and needs dependent care while working part-time? So in that case, the spouse would be considered gainfully employed and that requirement would be satisfied. So the spouse would be considered to be working for purposes of the dependent care FSA, and dependent care expenses would be eligible for reimbursement. Dependent care FSAs are subject to a substantiation requirement, which requires third-party documentation that the participant incurred an expense on a specific date and in a specific amount and a statement from the participant that the expense will not be reimbursed from any other coverage. The claim must be submitted by the deadline or by the end of the runout period, if any. Dependent care FSAs, like medical FSAs, are subject to the use it or lose it rules. In other words, amounts in the dependent care FSA at the end of the plan year are generally forfeited. Employers may offer a 2.5-month grace period, similar to a medical FSA. However, carryovers are not permissible under a dependent care FSA. There is no uniform coverage requirement for dependent care FSAs. As we talked about with medical FSAs, I basically have to be eligible for the maximum amount in my medical FSA that I elect at all times during the plan year to the extent that I haven't spent it down. That is not the case for dependent care FSAs. In other words, participants can only be reimbursed to the extent that they have sufficient funds in their dependent care FSA. Dependent care FSAs are also subject to non-discrimination requirements. Dependent care FSAs can't discriminate in favor of highly compensated employees with regard to eligibility or with regard to contributions and benefits. And for this purpose, a highly compensated employee is generally any employee with more than $130,000 in compensation in the previous plan year. And here's a couple more tests that apply to dependent care FSAs. First, no more than 25% of the amounts paid or incurred under the dependent care FSA may be provided to shareholders or owners. This doesn't come up too often because only shareholders or owners of subchapter C corporations are eligible to participate under section 125 of the code. However, the second test is much more commonly failed. The average dependent care benefits provided to non-highly compensated employees must be at least 55% of the average benefits provided to highly compensated employees. And we do see some employers that perform this test and fail this test. And those employers that fail may need to make a year-end distribution or lower the highly compensated employees' election in order to satisfy the test. There are some reporting requirements imposed on employers with respect to dependent care FSAs. The total amount incurred for the dependent care assistance must be reported in box 10 of the employee's Form W-2, and employees must file Form 2441, which is the Child and Dependent Care Expenses Form, to report their reimbursements when they file their annual Form 1040. There is also a tax credit for dependent care expenses. Generally, the tax credit is a percentage between 35% and 20% of an employee's dependent care expenses, up to a maximum of $3,000 for one qualifying individual and $6,000 for two or more qualifying individuals. The amount of the tax credit decreases as an individual's adjusted gross income increases. There is no double dipping allowed with respect to a taxpayer's dependent care expenses. To the extent I'm reimbursed for a dependent care expense, I can't also claim a dependent care tax credit on my individual tax return. Oftentimes in a summary plan description, the employer will include information advising employees that in some cases, the dependent care tax credit may be more advantageous than a dependent care FSA. And individuals should consult their tax advisors regarding what may be most advantageous given their personal situation. And with that slide, that concludes my presentation on compliant medical and dependent care FSAs. And please feel free to join us on November 16th or December 21st for our next employee benefits lunch break webinar series presentations. Thank you for your time.